The Fed generally gets all that data from government agencies a day or two before it's released to the general public. They trade on that information. So they're a group of brilliant traders and players in the Treasury and money markets, and they have some inside information, but they are not the end-all in the markets, and they cannot control interest rates. They can influence them, but not control them. If anyone has any doubts about the veracity of the scenario, I suggest they just look up two words on the World Wide Web, which apparently is the font of all knowledge nowadays. Black Wednesday. What does Black Wednesday refer to? Well, that refers to the date when Margaret Thatcher, hero of the Reagan Revolution, was basically forced out of office because she was overwhelmed by the markets who shorted the pound. The pound crashed. Margaret Thatcher commanded the Bank of England to defend the pound, but it crashed nonetheless because the Bank of England was dwarfed by the stateless euro-dollar market and currencies. And so just look up Black Wednesday if you want any sense of how the sovereigns are being overwhelmed by the enormous size of the markets. And they can influence the markets, they can guide the markets, but they can't control interest rates. Just ask Maggie Thatcher. Black Wednesday. This is what the Fed is concerned about, a possible Black Wednesday or a Black Thursday or a Black Tuesday in the future. This solvency crisis began in August of 2007. Basically, it started off with subprime and worked its way to other other sectors of the money market. One of the very, very best trades in the world since that solvency crisis began in August of 2007, consistently, month over month, to this very instant, has been buying U.S. Treasury securities, notes, bills, or bonds on margin. Buying treasuries on margin. There's been a flight to safety, a flight to quality. Everybody wants treasuries. Additionally, everybody wants good quality assets as opposed to subprime or ABCP, asset-backed commercial paper, or some of the debt tender obligations put out by the municipal insurers that are causing so much trouble in the monoline market right now with MBIA. Margin, buying treasuries on margin. That's been a fantastic trade. Why? Because the value of treasuries has gone up. Interest rates have plummeted, and so the notes that you bought 3 months ago paying X rate are now worth more because the treasury isn't paying as much anymore. Also because of the flight to quality, the price, they're more in demand. The price is going up. So that's been a fabulous, fantastic trade. Well, look, the Federal Reserve holds hundreds of billions of dollars in treasuries. They're making out very, very well in this whole episode. But stay tuned. Here is the endgame scenario that I'm talking about that has the central bankers extremely worried around the world. What happens if the value of those treasuries starts to go down? Now we know the dollar has gone down, and this has been a cause of some concern because it may affect inflationary expectations, and expectations are the name of the game. That would cause a rise in real interest rates, and there's nothing good about that. If there is a change in market sentiment caused by a dramatic rise in inflationary expectations, the markets will sell treasuries to compensate. They'll sell treasuries rather than buy them because over the longer term, if you're holding treasury bonds, for example, or treasury notes, and it looks like inflation is going to rise through an increase in inflationary expectations, everybody gets into the psychology of, well, prices are going up, I have to increase, you know the crap that went on in the 70s, then treasuries do very well in that type of environment, very poorly, forgive me, in that type of environment. Nobody wants treasuries, then they want the inflationary assets, the hard assets. When the Treasuries market is flooded with sell orders, the value of the Fed's portfolio would decline. They're a market maker. Like anyone else, they're a trader. They don't want to be sitting on a bunch of losses. So they're fine with a decline in the dollar as long as there's a bull market in treasuries. But if there's any turn in the treasuries market, what's the Fed going to do? Well, first of all, remember that the Fed isn't the biggest player in the world. So what the markets are going to do is they're going to sell treasuries. They're going to demand more to pay for the war in Iraq and the $600 billion defense budget and all our Social Security and Medicare programs. They're going to demand higher interest rates from the government. So that'll cause interest rates to rise, mortgage rates to rise, credit card rates to rise. Now, there's a bit of a debate in the United States about whether we're facing hyperinflationary implications from the current Federal Reserve policy. Let me ask you, if interest rates suddenly now were to go sky high on treasuries, on corporate debt, on housing, on mortgages, on credit card debt, if interest rates dramatically rose on all those, would that be hyperinflationary? Don't kid yourself. It would be hyperdeflationary, because the last thing this economy needs right now is dramatically higher interest rates. And don't kid yourself. The Fed would not hesitate to follow the markets in raising interest rates to protect the dollar from a catastrophic fall and a catastrophic fall in the price of their treasury portfolio, if need be. They would merely be following the market, just like the Bank of England was forced to do against Maggie Thatcher's wishes. Even she could control the markets. Sorry. So ask yourself, what are the implications of a dramatic rise in interest rates? That's the endgame scenario that everybody's trying to avoid, everybody's trying to manage. Apparently, very few people in the United States are unfortunately aware of it, but that's what's going on. Such a dramatic rise in interest rates when the economy is so fragile and so weak could push us easily into a depression. A depression is not hyperinflationary. The Fed, as a public-private hybrid institution, is simply not going to sit by and idly watch the value of its portfolios of treasuries crash. They would not hesitate to raise interest rates if the need arose to protect their holdings. Remember, they're not the biggest player. They would merely be following the lead of the markets if the price of treasuries crashed. And that's what we need to consider, is the endgame scenario and how to avoid it. A dramatically higher push upward in interest rates. I'm Mr. Fed, and that's the way it was. The end of March 2008, March 30th.